Good morning. This is the Global Markets Daily Brief for Saturday, the 7th of March, 2026. I am Jonathan Simkowitz. Every global investor has watched the footage: smoke over Palm Jumeirah, fire near the Burj Al Arab, debris on the tarmac at Dubai International. And the instinct, the natural instinct, is to ask whether Dubai is finished, whether the model is broken, whether the capital that flowed in over 2 decades will now flow out just as fast. But that is not the right question. The right question is this: what exactly are you repricing when you reprice Dubai? Because Dubai is not a city in the traditional sense. It is an operating system. It is a financial architecture built on 3 inputs: foreign capital, foreign labor, and the perception of absolute safety. Strip away the third, and you have to ask whether the first 2 can hold. That is the capital allocation question sitting in front of every portfolio manager, every sovereign wealth fund, and every family office with Gulf exposure this morning. So let us start with what happened. On the 28th of February, following coordinated United States and Israeli strikes on Iran that killed Supreme Leader Ayatollah Ali Khamenei and destroyed significant military infrastructure, Iran launched retaliatory missile and drone attacks across the Gulf. The UAE has been the hardest hit. As of this week, Iran had launched roughly 190 ballistic missiles and more than 900 drones toward the Emirates. The vast majority were intercepted, but debris and a small number of direct impacts struck civilian infrastructure in Dubai and Abu Dhabi. 3 people have been killed, 78 have been injured. The Fairmont Hotel on Palm Jumeirah took a direct hit. Jebel Ali Port, which handles over a third of Dubai's GDP, caught fire from intercepted missile debris. Dubai International Airport was damaged and shut down for days. DP World suspended operations, airlines grounded fleets, airspace closed across the Gulf. Markets responded immediately. UAE stock exchanges shut for 2 days, the first conflict-related closure in the country's history. When the Dubai financial market reopened on Wednesday, the 4th, it dropped nearly 5%, its worst session since 2022. Real estate names like Emaar led the sell-off. Banks followed. Emirates NBD fell over 5%. Citi flagged rising equity risk premiums across the entire region. Meanwhile, Brent crude surged from roughly $73 before the conflict to around $90 as of this morning, as the Strait of Hormuz effectively shut down. European natural gas futures spiked roughly 30% on the back of Qatar halting LNG production. Tanker traffic through the strait collapsed from an average of 24 vessels per day to just 4 within 48 hours. That is the first-order reaction. Let's step back. The consensus view forming right now goes something like this: Dubai's model is built on the illusion of safety. That illusion has been shattered. Expats will flee, capital will follow, real estate will correct, the city will enter a structural decline. Some of the loudest voices are pointing to the 2009 Dubai debt crisis as an analog. Former J.P. Morgan chief strategist Marko Kolanovic called it potentially catastrophic, noting that with 88% of the population being expats and huge exposure to tourism, aviation, and shipping, a prolonged conflict could send shockwaves globally. And parts of that framing are correct. The safety premium has been damaged. Private jet bookings have surged. Security firms report corporate clients evacuating thousands of employees. Charter flights from Riyadh to Europe are going for $350,000. Fitch had already flagged Dubai real estate as one of the top 5 bubble risks globally. UBS had flagged the same. A correction was coming regardless. But here's what the consensus may be getting incomplete. This framing treats Dubai as a lifestyle play. It misses that Dubai is first and foremost a trade and financial plumbing node. It is a logistics corridor. It is a regulatory arbitrage platform. It is the place where sanctions are navigated, where commodities are routed, where capital from South Asia, Africa, the former Soviet Union, and the broader Middle East finds a banking system that works. The tax regime has not changed. The regulatory framework has not changed. The banking infrastructure has not changed. The Golden Visa program still exists. The free zones still function. What has changed is one variable: physical security, and the market needs to price whether that variable is transient or permanent. Here's what I think is not yet priced in. The UAE is now actively considering military countermeasures against Iran, including potential strikes on Iran's launch sites. That would be unprecedented. It would mark a fundamental shift in the Emirates' posture from a defensive, commercially neutral actor to an active combatant. Additionally, the UAE is reportedly considering freezing billions in Iranian assets held in Dubai's free zones and cracking down on the informal currency exchanges that serve as Iran's financial plumbing. If that happens, it simultaneously strengthens Dubai's relationship with Washington and destroys a meaningful revenue stream from Iranian trade flows. That trade-off is not being discussed nearly enough. Also underpriced is the Strait of Hormuz dynamic. Morgan Stanley raised its Brent forecast this morning, projecting $80 per barrel for 2026, up from $62.50. But Brent is already at $90. The market is pricing something closer to a prolonged disruption. If transit normalizes over the next week or two, there is a meaningful amount of risk premium to come out. If it does not, we're headed toward double digits. Fitch has argued the closure is likely temporary because Iran needs the strait open as much as anyone. That's a rational assessment that may not survive irrational escalation. My base case is this: Dubai's operating model survives, but in a diminished form over the medium term. The conflict window, which President Trump has indicated could last 4 to 5 weeks, will create a temporary but severe demand shock to tourism, aviation, hospitality, and speculative real estate. Capital outflows will accelerate in the near term, particularly from retail investors and lifestyle migrants. But the structural users of Dubai, the commodity traders, the logistics firms, the financial intermediaries, the sovereign wealth adjacent operations, they will stay because there is no equivalent alternative. The infrastructure deficit elsewhere in the region is real. There is no other city between Singapore and London that offers what Dubai offers at the institutional level. The question is whether the conflict stays contained to this 4 to 5 week window or metastasizes. So let me walk through the scenarios. The base case, which I would assign roughly 50 to 55% probability, is that the conflict winds down within the stated timeline. The Strait of Hormuz reopens gradually. UAE markets stabilize after a 10 to 15% drawdown from pre-conflict highs. Dubai real estate corrects moderately, perhaps 10 to 15% on the high end, but the structural bid from golden visa buyers returns within 2 to 3 quarters. Brent settles back into the mid-70s as the risk premium fades. The key anchor here is liquidity. If capital markets remain functional and the UAE central bank provides backstops, the drawdown remains orderly. The bull case, perhaps 15 to 20% probability, is a rapid ceasefire or diplomatic backchannel, possibly driven by Gulf pressure on Washington, ends hostilities sooner than expected. In this scenario, the fear premium in UAE equities unwinds quickly. Real estate dips become buying opportunities. The narrative flips to resilience. Dubai proved its air defenses work. The interception rate was above 90%. Oil drops back toward 80, and the global inflation scare moderates. Risk appetite recovers across emerging markets. The bear case, which I would put at 25 to 30%, is an extended conflict. Iran continues to target civilian infrastructure. The Strait of Hormuz remains effectively closed for weeks, not days. Crude breaches $100. LNG markets stay dislocated. The expat exodus becomes structural, not temporary. Corporate relocations to Singapore, London, and Lisbon accelerate. Dubai real estate enters a multi-year correction, particularly at the ultra-luxury end, where speculative supply was already building. In this scenario, the equity risk premium across the entire Gulf region reprices permanently higher, and the growth expectations embedded in UAE developer and bank valuations prove far too optimistic. Notice that even in the bear case, Dubai does not cease to function, it reprices. There is a difference. What to watch over the next 1 to 2 weeks? First, Strait of Hormuz transit volumes. If daily tanker crossings climb back above 10 to 12 within the next 7 to 10 days, the energy risk premium begins to deflate, and the broader Gulf stabilization narrative gains credibility. If volumes remain at 4 to 5 vessels per day or lower, the bear case probability rises significantly. Second, watch for any formal UAE military action against Iran. If the Emirates moves from a defensive posture